Hey everybody, David Trungale here from TraderTours.com. I wanted to briefly analyze the investment risk pyramid, which we can see in this diagram breaks down different categories of investments, and we can see off to the right we have a corresponding arrow that reflects the degree of risk associated with these different investment groups. Now, this is a pretty mainstream model that you can find in the financial textbooks. In fact, you may have seen this in high school even. At the base of the pyramid, we have cash, for example, which is going to be the most conservative investment. In fact, I really would not call cash an investment. It's more of a medium of exchange than anything, right? It's a very liquid asset. In fact, it's the most liquid asset on the planet. We use it daily to exchange different goods and services within the economy. As we move up in the lower portion of the base, we can see CDs, notes, bills, money market, bank accounts, government bonds. These are all going to be relatively low in risk. As we move up to the middle, we can see real estate, equity mutual funds, large and small cap stocks, high income bonds, and other debt obligations. And as we move to the top, these investments are going to be the most risky, and this is listed here in the summit. We have options, futures, and collectibles. Now, if you want to get analytical, you could contest that if you trade options in a conservative way, such as selling out of the money covered calls, that it's actually less risky than investing in a basic small cap, for example. And there's a lot of truth to that, but again, this model is just giving us a general idea. So for the most part, I do agree with the structure that we have. Now, what this model does fail to underscore, and what most financial analysts fail to underscore, is that it's just as important, if not more important, to consider how you are allocating your capital and what amount you're allocating into each category, or maybe just into one category, because that is going to be a very important variable when you are considering risk. For example, if you have two people that have $50,000 to invest, and one person puts all $50,000 into large cap stocks, the other person keeps $45,000 in cash, but they put $5,000 into options. Well, based on this diagram, options are more risky. So immediately people say, they're taking more risk. Well, again, that's not necessarily true. Even though the degree of risk may be higher for futures or options, if the amount of capital is much less, then that degree of risk would shrink. So I would contest that the person who has all $50,000 at stake in large cap stocks may actually be risking more than the person who has just $5,000 in options, even though that particular category of options may be riskier than large cap stocks. So anyways, this is a basic tutorial and a basic intro to the investment risk pyramid. Thank you for watching.